Good morning, and thanks for joining us today. We'll get started shortly, but while we allow time for folks to join, a few housekeeping items for the webinar today. First, you may want to close other browsers on your windows on your computer to improve connectivity while viewing the event. Please also feel free to enter any questions that you may have by using interactive chat feature at the bottom of your screen. This event will be available post the event via email. We will send it out. We appreciate those who already submitted questions through the event registration, and we hope to answer them all, but if we run out of time, we will be sure to get back to you after the event. The webinar will be starting here in just a few minutes, so thank you for joining us. Welcome, everyone, and thank you for joining us today for the Greater Milwaukee Foundation's 2024 second quarter investor briefing. My name is Anne Marie Baumgartner. I am the Senior Director of Donor Services at the Foundation, and today I will serve as your MC and facilitator for this event. At this time, I would like to introduce you to our President and CEO, Ellen Gilligan. The Foundation has been fortunate to have Ellen's vision and leadership for the past 14 years, helping us to accomplish many milestones, most recently the Thrive On collaboration and our successful and historic Greater Together campaign, just to name a few. We are incredibly grateful for her contributions to the Foundation and her commitment to the community to build a Milwaukee for all. And we wish her all the best in her retirement. You'll hear more from Ellen in just a few minutes. You may have also seen the news, but we are so thrilled to welcome Greg Wesley as the Foundation's next president and CEO. He has a rich history with the Foundation as well as in the community, which positions him well to continue and build upon the Foundation's work and success. It's a very exciting time at the Foundation. Now, it's my honor to welcome Ellen Gilligan.
Thank you, Anne Marie, and thank you so much for everyone joining us today. It's amazing that I'm at the end of my 14-year career at the Greater Milwaukee Foundation. It has been such an honor for me to serve this institution and this community. People ask me to reflect on my tenure and my career, and I have to acknowledge that throughout my career, I have always raised my hand, put my hat in the ring for opportunities that drive growth and opportunity for others. The through line of my career has been to drive resources to underserved communities. And I recognize that transformational change requires courage and bold actions. So when I first came to Milwaukee 14 years ago, I tapped into a tremendous love for this community and that we must be in partnership with community to be the community foundation for everyone. I have on my office door a small sign that reads, "Change happens at the speed of trust." And in philanthropy, how we do our work is as important as what we do and what we invest in. So I have been on my gratitude tour for some time over the last couple of months since I've announced my stepping down from the foundation. And I want to just express my gratitude on behalf of the foundation for trusting GMF as a steward of your resources, as a convener, as a thought leader, and as a catalyst for change. We have had tremendous success through our Greater Together campaign. Our donor generosity has been outstanding of time, talent, treasure, and ties. We raised over $726 million, benefiting all areas of donor passion and co-investment where donor passion aligned with community priorities, moving the needle on critical issues such as housing, early care and education, economic opportunity, health equity, and to provide flexible resources for the future for needs that we can't possibly imagine. The most important thing that we demonstrated during this campaign is that everyone is a philanthropist, and we intentionally invited giving and celebrated giving and invited communities of color to join the foundation. This is a community foundation at its best. I like to say that we have demonstrated that community foundation is everyone's community foundation. So the Greater Milwaukee Foundation has always been a leader in the community foundation field. And as I look back over the last 14 years, there are so many milestones that are so important to this institution and the work that we've been doing. They're really too numerous to name, but I just want to highlight a couple. One is our Milwaukee for All, a bold strategic vision that unites the community toward a brighter future. Establishing racial equity as the foundation's North Star. Our Thrive on Collaboration, which is a magnificent view of how a community foundation can embed itself in the community and create transformational change. While the building took us a while to redevelop, I like to say that the building is just the beginning of what this partnership will produce over the long term. Our Greater Together campaign, which I just mentioned, which produced historic results with a historic approach. We were one of the first in the country to run a campaign, and secondly, a focused campaign that had some strategic focuses in it. So again, Milwaukee is leading the way in the field of philanthropy. And Milwaukee Succeeds, one of the first leaders in educational equity in this community. We have reimagined philanthropy, and the Greater Milwaukee Foundation is everybody's community foundation. And we are just getting started. Our commitment to transformational investment and change will continue. So in closing, I want to say a couple of things. One is I am so pleased that Greg Wesley has been appointed by our board to lead the foundation into the future. And secondly, I want to thank Mike Miller and Crucial Partners for your tremendous service to the foundation over many years. So thank you. And I look forward to watching the Community Foundation move forward. Onward.
Thanks, Ellen, and thank you for all your important work. We will certainly miss you. Now we'll move on to our investment briefing from Mike Miller. Mike is the Chief Investment Officer at Crucial Partners and an investment advisor for the Greater Milwaukee Foundation. Welcome, Mike.
Thank you, Anne Marie, and good afternoon, good morning, everyone. It's so nice to be here with you, and thank you for those very kind words. And I'm with Anne Marie. I want to just echo, you will be sorely missed. Super excited to have Greg on board, though. He's amazing. So I will, as always, walk you through some of the investment results, talk a little bit about what we're doing in the portfolios. There's been some changes, and finally spend some time on the market climate, which is one of the more interesting ones we've seen. And I think maybe just to start us off, I will tell you, I think this is, there are moments in time for investors which are particularly fraught with opportunity or peril. Usually it's one or the other. Today, I think it's both, believe it or not. And I'll explain a little later why I say something like that, but it's a complicated time, needless to say. So if we advance to the first slide, we'll go right to the investment performance, which you can see here. So as a reminder, the blue bars are the foundation's returns net of investment management fees. The gray bar is the consumer price index plus the foundation's spending rate, which is ultimately our objective over time. That's the North Star for any good investment strategy. The red and green bars are market benchmarks that reflect, in the case of the red bar, a simple mix of stocks and bonds, and the green bar, is a benchmark that's constructed to mimic the foundation's asset allocation strategy. So one thing you'll see, which will jump right off the page in the beginning, is something you have not seen in a long time here, which is that the blue bar, particularly over the last year, is significantly fallen behind the market benchmarks. And it's interesting because the reason that's happening is you might think, oh, you all must have made some huge investment mistakes. Actually, that's not true at all. The portfolio, you can see, is still up 12% over the last year. The problem with the return comparison right now, and I'm going to talk about this in a lot more detail in a minute, is that the foundation has about 15% or so of its assets in private assets, private equity, which are compared to public markets in the benchmark. And so the public markets are up 25 to 30%, and the private equity has essentially been flat over the last year. Now, for those of you who say, oh, your private equity program might not be working so well, actually, that would not be the case. The portfolio, that part of the portfolio is up more than 12% per year since we started it. So it's been a fantastic contributor to the long-term outcomes. But short-term, we're getting some significant, what I would call noise in the numbers. And just to give you one quick offer of proof on that, if you strip out the private equity and look at the rest of the foundation's investments, which is about 85% of them, it's actually right on top of the benchmarks for the last year. So that gap is all about private assets. So we're not overly concerned with it because we actually think we have an amazing private assets portfolio. And I guess I would say this, if the public markets continue to advance at 25% per year, yes, we might have some trouble keeping up with that, but that's really not a scenario we're particularly concerned with because it's incredibly unlikely to happen, just to be clear. As you go to the longer period, you can see the portfolio, particularly when you get to 10, 15, and 20 years, you can see the portfolio, the blue bar is still above the red and green. And for the most part, either hanging around the CPI plus spending or falling a little bit above it, depending on when you're looking at this. I'm going to come back to this in a minute, but let's advance to the next slide. And one of the things I think is really important is a couple of click-throughs, if you guys don't mind. One thing that's really important when you think about performance assessment is when you see these graphs, for those of you who've been at these sessions before, you would notice that every quarter I show you a graph and we show you a graph, and that quarter is just an endpoint in time. And so what's useful to think about is that when you came here a year ago, you saw a different comparison. When you came here 5 years ago, you saw a different comparison. When you come here next year, you'll see a different comparison. And it can be very confusing because if you see one that looks great, that's fabulous. If you see one that looks a little not so great, you might say, oh, maybe something's wrong. And the interesting part about it is that what you really want to think about is, well, what's the percentage of the time that you're doing well? Because that tells you a lot about basically the durability and the sustainability of your strategy. So that's what this admittedly somewhat confusing graph chart is going to show you. But I think it's really important that we look at this. So what we did here is we went back to 1997 when we first started advising the foundation, and we looked at every single 3-year, 5-year, 7-year, 10-year period there was advanced monthly. So if we've been having these sessions over the last 27 years, there would have been a lot of different sessions, of course. At a minimum, that's at least 100 sessions. So we captured even more data points than that because we did monthly, not quarterly. And the first line is doing something really simple, which is getting in these baseball seasons now in full force. We can say this, it's the batting average, i.e. what percentage of the time over 1 year, 3 years, 5 years, 10 years did the portfolio outperform its custom benchmark, just to be clear which benchmark, which is the policy benchmark. And you can see basically 7 out of 10 times, if we look at any 3-year period, it outperformed. When you get out to 10 years, it's 95% of the time. But really, basically, so if we thought about me showing up here and talking to you 10 different meetings, 9 out of those 10 meetings, we'd be showing outperformance for 10 years. But one of them we wouldn't. And so that's, baseball, I think it's well known that a 333 or a 400 batting average would be incredible. So we're pretty happy with our 70, 80, 90% batting averages, but they're not 100%. And we're in one of those periods right now where it's not above for 10 years. And so that's introduces some interesting questions. So first of all, we can't be perfect. We know that. But we like being close, which is what this shows you. The second thing, though, it leads to, which I think is a really important question, is high batting averages should give you confidence that the portfolio is actually very well invested and allocated. The other thing, though, you would ask yourself, I would ask myself, is, but there's a difference between outperforming by a little and outperforming by a lot. And a critical element of the strategy here, which we'll talk about several times today, is that we think to support the spending rate of the foundation and its impact in the future, we need to outperform by a lot, which means we need to do things that are different than the benchmarks. And that creates the risks of shortfalls over certain periods of time. So look at the median outcome line. What this is measuring is how much did you beat the benchmark by? So forget whether you did or didn't beat the benchmark. That was the first line. How much did you beat it by? And you can see if you go out, and first, these are not per year, these are cumulative. So the numbers get bigger as you go across the page, starting at 1.5, going to 11.6%, as you can see. And what's important to think about is that the 11.6% is the median level of outperformance. And what that means in English is if the benchmark had been up, let's say 50%, then the actual portfolio went up 62% over that period of time, again, net of fees. So it's a meaningful premium to the benchmark return. And that's very important because it answers a question for all of us, which is, is it worth it to take the risk on of underperforming? And the answer would be no if you outperform by very small margins. If you outperform by a lot, then maybe the answer is yes, which we think is the case. Now take a look at one more thing, which are the best and worst case outcomes. And in a perfect world, we want to see the best outcomes significantly outpace the worst. Now, the number that jumps off on the negative side is you can see the best and worst are about the same for 3 years. So we're not thrilled about that. We'd like to see that improve, and we're expecting it to improve, by the way. But when you get to 5 years, 7 years, and let's just focus on 10 years, this is really important. So for 10 years, the very best case outcome was 29.5% outperformance. Go back to my 50% gain for the index. That would mean the portfolio was up 80. Just to be clear about what that means. So it's a big, big gap. And when things didn't go well, again, this is not per year, it's cumulative, it was a 6.4% shortfall. So that's another thing to us that indicates that there's been a lot of skill applied here because the medians are high, the batting averages are high, and the skew towards positive outcomes is extremely strong once you get past the 3-year rolling periods. So hopefully this gives you all a little bit of comfort that when you look at this in the kind of the wholeness of time, that you get to see, what the future holds. And I will stick my neck way out here and say that what we're seeing in the markets today, while a little frustrating for us in the short term, gives us, I feel like we're going to get one of our best outcomes in history in the next 10 years, but we shall see. I'll have to answer that, I hope, someday down the road. So we move to the next slide. This takes the first slide we looked at and just changes it from annualized or per year to cumulative. And we show you this chart every time because it makes a really important point, which is that while we don't like any shortfalls, we don't like anything that doesn't look great, we are very focused on long-term outcomes because the compounding of capital over time is what creates impact in the community and creates impact for your funds. And so you can see, as again, not a surprise, as you go from 1 year where that comparison that looks so important on the first page now looks quite insignificant on this page, out to 15 years where you can see the portfolio significantly outperforming both the CPI plus spending and the market indices. And then for 20 years, falling short still of the CPI plus spending. We expect that to change, of course, but significantly outperforming both the 70-30 mix and the custom benchmark. And again, that's a critical element, which is to stay close. As we look forward, we're expecting, we think we draw this chart 10 years from now, the gray bar will still be difficult to beat. The foundation will achieve it like it has for 15 years, and the indices will not achieve CPI plus spending. And that's a very important component of the presentation I'll get to later. So again, this chart just gives you a really good visual of why we think the long term matters, because just the nature of compounding is important. And so per year is interesting. Compounding is much more important in terms of the value of your funds at the foundation. So we jump ahead again. We'll just click through. So how do we do this? The first thing, as I mentioned, it's easier to say this when your returns are great, but there's no acts of genius here. This is about simple blocking and tackling. And there are three basic principles we follow. One is to think long-term. I'm going to show you the strategic mix of the pool in a minute, the GMF pool, which has just recently been changed by the investment committee. And I'll explain how we change it in a minute. The second thing, there's no short-term forecasting here. So 2024 is a complicated year in the world's history. There's a lot of elections around the world, lots of things to think about. We think they're all important and interesting. We don't know what to do with them from an investment perspective, so we don't try. And that's what we mean by no attempt to change strategy based on near-term outlook. And the third thing, which has actually been, I've been in this business a long time, and usually the word diversification evokes a positive response and has a positive connotation. That's actually not the case today. You don't want to be diversified. You want to be concentrated in the Magnificent Seven, frankly, to put on the table. And the Magnificent Seven, of course, are Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla. And the more of those you own, the happier you are. If you don't own as much of the index, the less happy you are. And I think that's one of the things we're quite pleased at, the fact the portfolio is keeping up with the index over the last year, X the private equity again, even though it doesn't have as much NVIDIA and Tesla and everything else as the index has. It's kind of been a remarkable achievement here, which you can't really see in the numbers. But diversification is always ultimately the right answer to the question. We will come back to that too in a minute. So we jump ahead again. Here's the earlier promise of the mix change. And so as many of you know, the committee reviews the mix no less than once a year. They don't change it every year. So it's been a while since I've been here with a change to show you all. And when they do change it, it's a little bit, the committee's amazing, as you know, but it's a little bit like watching grass grow. We don't do anything dramatic, mainly because we're thinking long term. And unless markets are incredibly volatile, we tend to not react to them very much. So you'll see here, we've got the prior mix and the current mix. And what you're looking at basically is the fact that we've reduced the public equity exposure by 4 percentage points from 62 to 58. We increased the bond exposure modestly from 12 to 16, and the alternatives are basically the same as they've been. Mission Investments, for example, has the Thrive On investing and going on, which Ellen has referred to earlier. And it's a fantastic part of this portfolio as well. So you might say, oh, you cut your equities, increased your bonds. Are you predicting a market crash or some other problem? And the answer is no, absolutely, we are not predicting a market crash. But as I'll show you later, we are worried that the indices in particular, the US indices in particular, don't have incredible return prospects going forward. And because interest rates are higher today, all we've essentially done is said we're not getting paid enough in additional return to take on the risk of equities. We might as well own bonds. And I will give you some numbers to back up in a minute. But that was the genesis of this change. So again, there's no market forecast on this. And as you can still see, we've got 84%. I'm adding the total equity and the total alternatives of the portfolio in high returning long-term asset classes. So 16 is hardly a large percentage, but again, there's always a competition for capital going on. And when interest rates change or stock market prices move in one way or the other, we are going to very cautiously react to those things. And again, you have to get paid to take on risk. It's a critical element of any good investment strategy. So we'll move ahead again to the next page and talk about, Ellen referred to the foundation's commitment to racial equity. We're also committed to racial equity, but we're also committed to great investing. And that's something that I think is very deeply misunderstood in the institutional investment community, which is, I think there's a view that racial equity is somehow inconsistent with great outcomes, that you have to make a trade-off of some kind. And I can't tell you how categorically false that is. We've been aggressively pursuing and looking for diversity in our investment manager lineup for more than 10 years, which means that we've met with hundreds of managers that are not white male owned firms. And I got to tell you, we have found the same low level of talent that we find in the white male community. So it's about 5 to 10% of managers are good enough to manage money for the community foundation, and that applies across ethnicity and gender. But the bars are the same, and the investment outcomes are expected to be just as good, regardless of the color of anyone's skin or their gender. And so it's a really important part of the strategy. And as we've written here, success is higher when you have people who come from different backgrounds, who see the world differently. It gives us a bigger opportunity set to look at, because people look in places that we might not otherwise look at in our sphere of knowledge as individuals. And two, it gives us people who are thinking differently from one another, particularly around where risks might lie. And that's something we have discovered time and time and time again. And, to me, if someone said to me, I don't want any diversity in my portfolio, I don't believe in diversity, I would say, well, that's your call, of course, but I'm telling you, you're going to lose return if you don't pursue the strategies that embrace this concept, which is exactly what the GMF has done. And if you turn to the next slide, you can see our quarterly report card that we show you. It's a little hard to read, I'm sorry, but you can basically see here we've listed the managers that are majority owned. Basically, as you can see in the definition below, by ethically diverse individuals. And frankly, it's 25.3% of the GMF portfolio you saw before is in the hands of the managers listed here. And you can see they span asset classes from public equity to private equity to bonds. And so it's an incredibly successful part of the portfolio. And again, it's completely built from the bottom up, which is just let's go find great investors and let's be mindful of how to capitalize on the benefits of diversity, which is what you see here. And if you look at the top, just that first bullet point, which is an immovable number, less than 1%. Some people peg it at 2% if you want to be generous, of institutional capitals in the hands of diverse managers as we've defined it here. And so the foundation is at 25%, so literally 15 to 20 times more exposure to diverse managers. And we can go further, and we'll go further, by the way, because we're still finding talent all the time. So we turn to the next slide. Let's talk about the market for a second. So this is something that is just an unbelievably fascinating topic. And I have to tell you, I think we've almost reached the stage of this particular cycle where the dominance of some of these big US growth companies is such that it's almost you can't say anything bad about them. And we've gotten to that part of the cycle, which is always interesting to me. It always means it's about to change. So what you look at this graph, which is, I think, really important to gain some perspective on where we are, is this graph is showing you the relative returns between the S&P 500's top 10 names over time from 1957, as you can see at the bottom scale, through now, compared to the other 490 stocks in the index. So again, the S&P is 500 stocks, as the name suggests. The top 10 by size compared to the 490, equal weighted in both cases. So we're not, ranking them by the size of the company outside of that top 10 top 10 division. See the way the blue line mostly heads downward over time? What that's telling you, and this might be a surprise to many, that the 490 stocks have significantly outperformed the top 10 over time. And that happens because when companies reach the top 10, what usually happens next is they have to fall from grace. And that's usually the way it works. I hate to tell everyone who loves the stocks that are top 10 today, this group will be no different than any other group. We had DEC, we had Polaroid, we had Kodak, we had IBM, we had ExxonMobil, we had all these companies, by the way, many of which are still around, but they're no longer the darlings in the market. And the current darlings won't be the darlings forever. I hate to break it to you all. But what this graph is showing you is the impact that has over time, which is pretty significant. So you can see, if you look at the top lines, it's a little bit backwards from my thinking, but negative 2.4% per year since 1957 basically means that the 490 outperformed the top 10 by 2.4% per year over the last, that's almost 70 years. It's a massive, massive return advantage. Now look at the areas that we put the little boxes on. Those show what we call the counter trends. Now, that's a little bit snarky out of us because most people would think that the trend in place right now, which is that line going up, is the past, present, and future. And so we're certainly showing you right here, it is definitely not the past. It most certainly is the present. And our argument will be that at some point it will not be the future. This line will continue to do what it's always done over time, which is switch and go downward, which means that owning everything but the top 10 will be better for you. But the point of this graph is just look at how unusual it is for the top 10 to do as well as they've done. And, again, there's always a dangerous place you get to where people say, well, but maybe this group is different. And maybe they are. I doubt it. We doubt it. But let's assume they are for a second. That's okay. But what if they're not? And what if you have all of your apples or your eggs, in the basket of these names? It's important to say there's a chance that history will change. But there's also important to acknowledge and respect history and what it tells us. And it's telling us something very clear here, which when we jump to the next slide, we'll try to illustrate this a little bit more. So as you may remember, we've been through this before together. I want to explain it's a little bit complicated, but we love to look at something called a Shiller ratio. So Bob Shiller is a professor at Yale, who came up with this idea that the problem with trying to figure out what companies are worth and what they should be worth, which is we call a price to earnings ratio. So whatever a company makes in earnings times a certain number should get you the stock price. The higher the price earnings ratio, the more people think the company is going to do great, the more optimistic they are about it. It's the way to think about it. The lower the price earnings ratio, usually the more pessimistic people feel about a company. And what Bob did, which is important, was he came up to this idea that, listen, the problem with price earnings ratios is that they get distorted by short-term outcomes if you look at them over very short periods of time. So for example, in March of 2020, when earnings basically collapsed with COVID, price earnings ratios looked very high, but that was a little bit of a fiction because earnings were going to eventually come back when the world reopened. And so the price earnings ratio could be deceptive. So Bob's admittedly simple but brilliant observation was, well, why don't we just get rid of that problem and just use 10-year averages adjusted for inflation of the E? And then we get out of the cyclicality of either a normal recession or a COVID crisis or whatever the crisis of the day may be, and get to real facts, essentially. So what he does, which is great, is he goes back, I think, to the 1880s on his website. I really should know what that is, but it's a long time ago. And he published for the S&P 500 every single Shiller ratio over time. So what we did is we put them in these buckets. You can see we're 4.8 to 10. Again, that's that very pessimistic low Shiller ratio, up to 40, which is a very high Shiller ratio. And we put them in these buckets. So number of observations means out of this, what is this? This is like 1,500 data points. Essentially 226 times out of the 1,500 or so, it was a very low Shiller ratio. Look at the top, the 21, the 13, and the 23. That's kind of where we're at today. And we're right above, actually, when I did this graph, it was 34.3. The Shiller ratio is now closer to 35.5 today. So it's in that second line right now is how high it is. So 13 times. So the first thing that ought to jump off the page at you is, wow, only 34 times in history has a Shiller ratio been this high. That if it doesn't make you nervous, it should. Then go to the right, which is incredibly important. So then what we did is we said, okay, we know what the Shiller ratio was. Let's just measure what happened next. What was the S&P 500's return, including dividends, by the way, for the next 10 years? So look at the medians on the right. You can see that. So median, again, is the middle of the distribution. So half of the times it was better than that, half the time it was worse than that. So at a Shiller ratio of 35.5, the median return in history was 2.6% per year for the next 10 years. You talk to anybody who invests in the S&P 500 today, they are not expecting to earn 2.6% per year, particularly when you can get about 5% in your money market account right now. So why would you accept that? And that's the challenge of this time, which is that history teaches us some very important lessons here. Now, look at the range. I showed you mins and maxes before for the foundation's outcomes. So the worst case was that S&P actually had a negative 1.4% return per year. That's not after inflation. That's not subtracted from it. That's an actual loss per year for 10 years. And the very best thing that happened was 4.7% per year. So really important to think about that, because I mentioned something earlier. I said it kind of as a flip comment, which is, well, we don't know how the indexes support CPI plus spending going forward. This is what we're talking about right here, which is if you're trying to spend 4.75 or 5% per year, and you have 2.5 to 3% inflation, you can't afford to make 3% per year on your stock portfolio. You'll be in massive trouble. So this is why we were very nervous about where the world is heading in terms of how people are investing capital and concentrating in these names. Now look at the little green circle though. So that's why do we circle that? We circle that because that's where a ton of the foundation's portfolio is actually priced today. So yes, we own some of the Magnificent Seven, which are in these top groups. We also own a lot of smaller and mid-sized and companies in both US and non-US that are trading at extremely reasonable prices. So I mentioned this comment. I said, wow, it's one of the most basically perilous and interesting times at the same moment. And that's what I'm talking about, which is that if you're in these top-heavy indices, you've got some peril to think about. If you're everywhere else, you should be pretty excited because there's some great returns coming. And we expect that gap between the green that we'll earn and the red that the index will earn to be a very important part of the foundation's long-term future. So it's really significant to think about what this means. I will add one more thing. Shiller ratios are incredibly useful for 10-year forecasting. Incredibly is the answer. It's like finding the holy grail of asset class forecasting. Where they are completely useless is 12-month forecast. So for the next 4 quarters or 8 quarters, I hope to have the pleasure to be here with you either on Zooms or in person. This stuff means nothing. But 10 years from now, it means everything. And that's why it's important. Ellen mentioned the importance and the power of community foundations. Community foundations can take these long views and position their assets to capitalize on opportunities like this one. So we'll turn to the next slide. So this, again, just one more, hopefully nail in the proverbial coffin of what's happening is I mentioned perilous several times. It's perilous because what you're looking at here is how dominant these companies have been. So the top 10 names are now 33.4% of the index. So let me just explain something technical for a minute. The way indices like the S&P weight companies is based on the size of the company, so i.e. the number of shares outstanding times the price gives you a market capitalization. So you probably, have you been paying a little bit of attention, you've probably been reading about the great battle of the $3 trillion companies like NVIDIA and Microsoft, et cetera, in terms of which one's the biggest in the index. And the fact that these companies are $3 trillion companies means their weight in the index keeps going up and up and up because they're outperforming other names in the index. And the reason I think this graph is so important is you can look at history. Normally, the top 10 names are about 20 to 22% of the index. Today, they're 33.4% of the index. So there's 2 things to think about. First of all, is what we wrote at the top. You cannot escape a simple fact in investing, that if you concentrate your risk in less things, you both have the opportunity to do well, but you also have the opportunity to do very badly. So concentration and risk are synonyms. There's no exception to that point. And we think about that all the time. So the fact that the index is more concentrated by definition makes it more risky. Another related point to that is the fact that people look at the S&P 500 and they forget about the fact that the Magnificent Seven today have more than 20% of their revenues come from China and Taiwan. And a lot of people are very nervous about investing in China directly, yet they're not worried about the fact that a very optimistically grouped price of companies is highly dependent on there being no trouble in China and Taiwan. So I think it's another interesting thing that is just a synonym of our times. So we jump ahead one more slide. Excuse me. So a lot of times people ask me the question, what's going to make this change? And this has been such a long cycle of dominance and power for the S&P 500 and for the Mag 7 in particular, I mentioned earlier. And we really can't answer that question because markets are a mystery to us. But I did think it was important to look at this chart very briefly, which shows you what the earnings growth rates have been since the first quarter of 2023 for the Magnificent Seven, which are the red bars, and the everything but the Magnificent Seven, the S&P, which we've been talking about. And by the way, here you can see, look at those red bars from the second quarter of last year through actually now. These companies have been growing much faster than the rest of the index. And that's, again, there's a lot of complexity around how companies get priced in the markets, but you can see why people are attracted to them. I mean, it makes perfect sense. There's nothing literally wrong. We think it's gone a little too far, but the fact is that you can see how dominant these names have been and how special they have been. And that has left that big disparity in valuation I mentioned earlier when I looked at the S&P Shiller chart. But look at what happens starting in one more quarter, which is the earnings growth rates actually are about the same. In fact, the Mag 7 might grow quicker. So these are just Wall Street forecasts for earnings and not our forecasts. And then we think that might be the catalyst, i.e. people say, wait a second, why would I pay 40 times or 50 times earnings for a 15% growth rate when I can get the same thing for 10 times earnings? We don't know. We'll see. I look forward to, again, future events and having to answer for these numbers. But it's an interesting thing just to consider as a potential catalyst for change. Others exist too. So last slide, I believe, is what we're going to do. So the first thing is we're going to stick to a strategy that over 25 years has produced dominant returns well above indices and competitive with CPI plus spending. And we realize that time is on our side. So guessing what happens in the short term is fantastically interesting and can be entertaining, but it's also very risky. And we don't take risks that we don't think we're going to get paid to take. The second thing is the foundation, because Ellen mentioned the fantastic fundraising that's happened here and the fantastic size of the assets. We have scale, stability, and a long time horizon, which lets us access some incredible investments. In fact, I'm looking forward to probably the next time I see you talking about one in particular. We have a massive success in the portfolio right now that has not actually, it's not in the numbers at all I showed you. And it's going to be really exciting to talk about it when the time is appropriate. We do like index funds. We're nervous about, as you mentioned earlier, I mentioned earlier today, the S&P 500's concentration and the optimism in some of its pricing, but we love it combined with compelling managers. And then the last thing is volatility makes us all nervous, but it also provides amazing opportunities for long-term disciplined investors like the foundation. So again, I really appreciate the opportunity to be here with you today. I think that we're going to jump back to Anne-Marie for some Q&A. And this is, sorry. Crucial Partners is a New York City-based firm. You can see some of our stats here. I've been fortunate enough to be with Crucial for 38 years, and it's been a wonderful time for me, and it's been wonderful to work for the foundation, of course, over these years. So thank you.
Thanks so much, Mike, for the informative and comprehensive, presentation. We're just so grateful for your expertise and guidance, and really commitment to helping us steward and grow charitable dollars for our community. So thank you so much. So at this time, we're going to go through a few questions that we have. Let's see. The first question that I have is, how does the investment strategy support long-term sustainability and the growth of the GMF pool?
I'm sorry, Amber, can you repeat that question for me one more time? Apologies.
Oh, sure, no problem. How does the investment strategy support the long-term sustainability and growth of the GMF pool?
Oh, my apologies. Well, I need to hear that twice. Sorry. So basically, if you think about the long-term mix that we talked about earlier, the bias towards equities and alternatives like private equity are all done with a very simple process of which is to underwrite to high rates of return from taking on the risks of dealing with either the volatility of the stock prices or the businesses themselves. And so we expect to earn 8, 10, 12% returns from that group, which in turn provides the wherewithal and the return to support the long-term mission of the foundation and its impact. And I think that's why when you think about the way we construct the portfolio, a lot of times people will say, well, I need to earn, I don't want to lose money, they might say, or they might say some other objective. The foundation defines losing as being underneath that 8% return threshold I mentioned earlier. So we underwrite all the investments to get above that, but we also counterbalance them with some bonds. And as I mentioned earlier, when bonds provide a somewhat competitive return to stocks, then we will accept that lower return in exchange for a little bit less volatility in the portfolio, because that also can be useful when it comes to obviously grant making and rebalancing. When the stock market hits pockets of weakness, which seems so rare these days, but will return, basically we have the wherewithal to rebalance, which is also powerful.
So I think maybe you talked a little bit about this, but I'm going to ask it here, which is basically under what circumstances would you consider changing the investment strategy for the investment pool? And kind of that goes a little bit along with that is, maybe on people's minds today, which is, with the leadership change, will this affect how the funds are invested?
Yeah. So the changes occur when the markets change for the most part. So again, we stick with those principles. For long term, we don't know what the markets will do in the short term, and we think diversification is still a free lunch, even if right now it doesn't feel like it so much. So what that means is it drives us to changing the portfolio when market prices change in a mere material way. So every little blip doesn't affect anything. But let me give you some examples. If the stock market tomorrow were to fall 40% and the bond market were to stay where it is right now, you can rest assured that the investment committee would be discussing and most likely changing the mix to own more stocks. If, for example, the stock market rises 50% more and the bond and yields basically rise, you might expect because you might expect us to own more bonds because interest rates are higher. So again, we react to things that are just facts in front of us, not short-term predictions of what will happen next, because the world's too complicated to make good predictions. As it relates to the leadership change, I mean, this is a portfolio strategy that, of course, the investment committee and ultimately the board decide upon. So they have the right to change their minds. But nothing in my experience with the board or the investment committee suggests that we're going to abandon a long-term strategy that's been successful these years. There's always tweaks being made to it and changes that are important to think about because we're not sitting still. But massive change related to the leadership change, I don't think is something you should expect to see.
Great, thank you so much. Let's look and see. Do you feel that the stock market is overpriced?
I love that question. You might be surprised by my answer. I'm going to play word salad for a second with you. Overpriced or overvalued are terms that are used interchangeably, so I'll use them both for a second, and then I'm going to change to a different term. And the problem I have with when you say is the market overpriced or overvalued is it's a really hard question to answer objectively, because the problem you have is that the value of something from an equity or a bond perspective really requires that you look into the future. and figure out, okay, what am I going to earn from this investment? I discount it back, I get a valuation. That's how investing should be done. It's not done by many people, but that's the right way to do it. So when you say, is it overpriced or overvalued? I'd have to know the future with certainty to definitively answer that question. So I'm going to change the phrase and then get to a conclusion, because I'm being very, I feel like I'm being very vague at this point. So the phrase I would prefer to use is the market optimistically priced? And the reason that the word optimism is more important than valuation or price is that it tells you what the margin for error is. And so the indices today are extremely optimistically priced. And so I think what's important about that to understand is that if anything goes wrong in a big way, i.e. China crosses the Taiwan Strait, and we have a deep recession, we have a massive credit crisis, there are lots of things we can all point to that could be very disruptive to the world and to this country. You don't have a lot of places, a lot of safety in the price today. There's too much optimism in the prices. That makes me nervous. The other nuance that's worth mentioning just for a second is that it's not the market that's optimistic. It's a small group of companies at the top of the market that are very optimistically priced. The rest of the market feels very pessimistically priced to us, actually. And that's why we're kind of thinking, wow, if something bad happens, the whole market will struggle. Don't get me wrong. There's no escaping the short-term implications. But the process of a very inexpensive thing surviving can be very profitable for you as an investment. A very successful thing that's very expensive, it'll survive, obviously, but it will have a terrible rate of return for you. And if for those of you who want to look at what that looks like, take a look at, for example, Microsoft stock price from 2000 to 2018. That's a great company. It's one of the Magnificent Seven today. It was a horrible stock for 18 years. And so that's what happens when things are too optimistically priced.
Wow, thank you.
You're welcome.
Appreciate that. So we have a few other questions here. One is, how does the portfolio view the current rate inversions?
Yeah. And to explain, so for those of you who don't think about interest rates all day, so what I'm sure the question is referring to is that the short-term interest rates are higher than long-term rates right now in the United States. And that's happening because of the way the Federal Reserve sets the short-term rates, and the long rates are a little bit more set by the markets. And so the inversion, what it typically means, first of all, it used to be, and this is one of the things I think it's important to bring up, it used to mean a recession is coming. That's kind of the signal that markets tend to take from it. We've yet to see this recession, and the curve's been inverted for quite some time, which I think is something worth thinking about in terms of these old rules don't always work, and I think that's important. The second thing, though, in terms of how it affects the foundation portfolio, we're of the view that the higher rates on the short end are very useful to capitalize on. And so we have short-term investments that do that. But we're also wary of the fact that when you don't have a lot of bonds, you really do want to have more of those longer term exposures. And the reason you want to own them more, even if the rates are a little bit lower right now than the short, is that if something really bad does happen, i.e. we have a very deep recession, again, a credit crisis, something like that, interest rates will probably fall because inflation won't be as big a concern in those scenarios. And when rates fall, short-term bonds don't generate much gain from them. You just get lower yields on them. Long-term bonds in a declining rate environment have big capital gains that happen because you own bonds with higher yields than the current market's yields. And what that matters only because, I'm sorry for that, that matters because you need to have a hedge against your equity exposures, because equities will not do well in a scenario where the market's rates are dropping like that. So it's a very important portfolio construction technique to have more long-term bonds. And we really think about that from portfolio construction, as I said. So the inverted curve is interesting, but the more important factor is the portfolio's diversification, which is why we own longer-term bonds too.
Great. So one more that just came in during our presentation would be, why do you use 30% fixed in your benchmark when your fixed holdings have been below that?
Yeah, it's a great question. So the reason we do that is the 70-30 blend has a volatility profile, it's very similar to the overall portfolio. And the reason you can tie that back to the lower bond exposure is the portfolio has hedge funds and private assets. And when you put the whole thing together and you look at it in aggregate, it's got about the volatility of the 70-30 portfolio. So we pick it because it's important to have a simple 2-index fund portfolio that's got about the same risk levels as the aggregate GMF portfolio have. Now, again, the reason that we show you that index is because, as I mentioned, it's simple. We also show you the custom market benchmark as well, which importantly has the policy mix. That low bond mix is what's in the policy benchmark. So that target benchmark we showed you earlier, the second one, that one addresses the fact that the fixed income is in fact lower. So that's the reason we do it that way.
Great, thanks for answering that one. I think that we have one more question, and then I think we'll go to close. Can you share a little more about the mission investments?
Yeah. So the Thrive On investment has been a part of the portfolio. It's obviously part of a fantastic program, which I can't do it justice, so I won't try to do it, but I think many of you are familiar with it and the incredible work the foundation has done there. That's part of it, but there will be other investments as well where the foundation is seeking to use its capital in a return competitive manner to support the foundation, support the community, excuse me, in very different perspectives. And I think when we can blend all these things together into the pool of capital, it's really beneficial to everybody. We have a lot of clients who do this today and do it the way the foundation is doing it, which is, I think, very thoughtfully. We're asked to opine on how to construct a portfolio to make sure that the returns that you see in aggregate stay at the levels they need to be, and we see no trouble doing that whatsoever. So the bottom line is these are investments very specifically targeted to the foundation's mission, to your region, and that they also fit into an overall investment strategy for the portfolio.
Thank you. That's really helpful. So thank you again, Mike, and we really appreciate it. And we're looking forward to hosting you in person in August to have an in-person investor briefing. And I'll talk more about that here in just a minute, but really excited to start that again. So just a few reminders then and closing remarks. If you have any questions of what you heard today, please be sure to contact your philanthropic advisor or contact at the foundation. An email with a recording from the webinar will be sent out after the event. We're just so grateful for your partnership with the foundation, and I'd like to share a few upcoming events that will be held at our new office at Thrive on King. So we have our donor meet and greet on July 23rd from 4 to 6 p.m. And then we will have our Q3 investor briefing in person at our office on August 14th from 8:30 to 9:30 a.m. And I really, truly hope that you're able to, come and join us for these events in person, and stay tuned for more details. And thank you for joining with us today, and have a great day.